first thing kind of want to talk a little bit about is a quick crop insurance update. We did end up setting our spring prices for Tennessee, and so we want to make sure that we're maximizing our risk management tools in terms of being able to successfully end up implementing those. Then I'll talk a little bit specifically about corn and soybean, just a quick supply and demand update, and then give a quick price outlook. And then I'm going to step through two option strategies, one for corn and one for soybeans. It's something where, you know, with the current price environment, I think it's going to be important for us to consider some of the different marketing strategies that might work well under the current conditions. So kind of step through those after we talk about some of the prices. So we look at the projected crop insurance price, the spring crop insurance price for our kind of key spring planted commodities in Tennessee. The first thing that jumps off the page for everyone is the fact that for 2020, we are going to start with the lower price relative to 2018 and 19, substantially lower for cotton and soybeans. Corn is also 12 cents lower than 2019. So again, when we're looking at that from a revenue product, what we're starting with is we're starting with lower revenue guarantees. There are a couple of, I guess, mild bright spots with that. It can translate into lower premiums, maybe. It depends on the volatility factors, which kind of leads us to the point, should we end up looking at potentially having a bit of a higher buy-up on our crop insurance products? Again, get with the crop insurance agent if you haven't, and make sure that you kind of crunch those numbers. The other one that was kind of an adverse effect of this is it can influence availability to credit. If you are looking at getting loans, banks will sometimes end up factoring what that revenue guarantee in total credit. When you look at the other option, you can look at the supplemental coverage option. So that is something that could be considered as a buy-up. And I always recommend not opting out of the harvest price option because we typically get pretty good returns.
Can you hear that?
Long term. Yeah. So when we look at this, one thing that I do want to point out, and this is in particular for
closer to see it.
In particular for those that are prone.
This little old thing that you click on, turn the sound up.
Particularly those counties that are prone to any type of flooding, buying up that 5% prevented planting option might be a pretty good option, particularly in West Tennessee. When you consider how much rain we've got through a lot of these areas, that might be some pretty good coverage to end up purchasing if you do have farms that are prone to flooding, just given the saturation of soils and the high reserve levels that are within the watersheds right now. So that's one to consider. I'm not going to spend much time on this. I do want people to be aware that deadline is March 15th for the ARC PLC sign up. I'm not going to talk any more about that, but make sure that you've got into those FSA offices because you don't want to leave any of that money on the table. It does look like we might end up getting a MFP payment, a 3.0, if you will. If you would ask me 2 months ago, I would have ended up saying there's probably a less than 25% chance that we would end up getting that. Now when we look at it, I think there's probably a greater than 75% chance just with what we've ended up seeing as a result of the coronavirus and some of the other factors that have adversely affected commodity prices. We haven't really seen much of an impact in terms of that phase one and kind of kick the can down the road. We'll have to see what the long-term impact of that is. So again, when we look at the potential for those payments, I don't necessarily think we want to factor that in terms of profitability, but it is something that might be coming down the pipe in order to help with some of the low commodity prices. One thing that is kind of interesting to contemplate is the form of those payments. If you think back to 2018, they're based on commodities. So again, soybeans received the bulk of the payments under that program. Cotton did all right as well. Whereas in 2019, it was a county level payment. And so the big question is going to be, what does that form look like if we do end up getting a payment in 2020? And so when we end up considering that, you know, if we look at overall in Tennessee, what we ended up benefiting from more, it was actually more beneficial for us under the 2019 system rather than the 2018 system, just because of how low the 2018 payments were on corn in particular. So when we first start talking, I do think it's important to kind of recognize the price environment that we're in. I've shown this slide at several of the grain conferences, but I really do think that we're in a price environment where we're going to just bounce around that cost of production. We're going to kind of move flat. Yes, there's going to be some volatility, but I think it's going to be a reasonably narrow range unless something fundamentally changes on the demand side. We do have large supplies, and we do have a diversified global production system where it does make it easier for supply disruptions to end up bouncing back, just because we do have production in both hemispheres and we do have multiple countries that are producing. So again, when we think about it, until we have a new demand driver, it's likely that we're going to see our commodity prices. Yes, they're still going to have some volatility to them, but I think they're going to move more sideways. So when we look at what I mean by that, if we look at this green box here, where we will go from 1989 to 2003, that's kind of the price environment we're looking at. When we look at the long term, it's just moving pretty much flat. And so again, we're obviously at a little bit higher level, but I would expect us moving flat. This anomaly here that we ended up getting from the ethanol boom, we don't expect that to end up coming unless there's another source of demand. And one of the ones that I had several people say, well, is phase one going to be a source of demand that could move us out of this? And my answer to that would be probably not. There's a couple of reasons for that. Yes, it would be incredibly beneficial to see some of these Chinese purchases, but if you take something like soybeans that are a pretty good example of this, if you ended up having Brazil and the US are the two primary providers of soybeans. So again, when we're looking at that, if China's buying more from us, they're typically going to be buying less from Brazil and vice versa. And so again, you're going to get some backfill through other countries in terms of being able to end up having the same number of soybeans relative to the same amount of demand. The one exception to that would be if we do see the Chinese come up with some type of stockpiling program. And for those of you that are familiar with the cotton industry, that can provide a short-term boost in prices, but there are long-term consequences to that. Essentially what you're doing is you're substituting demand today with supply down the road. And again, that has its own price implications. So that's kind of the current market environment. I'll start out with kind of the futures contract prices for new crop in terms of what I'm kind of seeing as a reasonable marketing range. So corn 350 to 420 on the December contract, soybeans 850 to 1050 on the November. Bigger range in soybeans just because of some of the issues that we could potentially end up seeing with Chinese demand. When we're looking at kind of a marketing approach to it, we need to take advantage of those profitable opportunities that pop up. We need to be ready and willing to pull the trigger on that. And then look at all the tools in the toolbox. Obviously, storage and basis in Tennessee are two really important tools in our marketing toolbox. The one I'm going to talk a little bit today is a couple of option strategies, one for corn and one for soybeans. But I don't want to say those are the only strategies that will work. There's numerous ones out there, and I think we do have to kind of recognize the fact that we want to use all the resources that are available to us. So when we think about corn, I'm not going to dwell a lot on supply and demand today, but if we look at the estimates for the 2020 crop that the USDA released just a couple weeks ago, they are anticipating a large crop, 15.46 billion bushels, which would be the largest production that we've had. A lot of that is driven by the increased acreage. Now, we don't know what that's actually going to be. These are all projections, so we do have to put a grain of salt in this. But again, the number that worries me is this 2.6 ending stock, 2.6 billion bushel ending stock that they're currently projecting. There is, like I said, a tremendous amount of uncertainty in that number, so it's not set in stone by any stretch of the imagination, but a 2.6 billion bushel carryover translates into an average farm price, if you follow the WASDE report, somewhere around that 330 to 340. So again, I think we have to recognize that if we do see something like this, we'll see what the planting season brings. But right now, it is definitely a little more bearish on the corn side if we do see numbers that are similar to this. Exports do rebound a little bit. So again, that is another one that is kind of a wild card as well. Global production, again, accessing markets. you know, we have seen stocks come down, so that is positive. But again, with the uncertainty regarding trade and global economic activity because of the coronavirus, it is kind of concerning that we might not be able to access some of these markets to the fullest potential. So when we look at corn prices, this is the monthly average of the December futures contract over 2020, 2019, the 5-year average in red, and the 10-year average in black. So the first thing that we should point out is that 10-year average, we're probably not getting back up to those levels. That includes some of those high years that we ended up seeing back in the mid-2000s. What we do want to end up doing is looking at the opportunities that we did have in 2019. They're reasonably short-lived. Typically what we end up seeing over the last 5 years, so we don't have a drought year in there, but that March, April, May is when we kind of had that peak in terms of our pricing opportunities. Does that mean we're going to have it this year? Maybe not, but it is a reasonable starting place to end up looking at doing some type of a pricing strategy. When we look at the direction that the December corn futures contract is going, there were some better opportunities back in the early part of this year and in 2019. But again, what we have is we have a reasonably consistent trading range. This only goes from 420 down to 375. So we're not talking about a massive trading range here. There are numerous factors that are going to push this. One of the other ones that is interesting to kind of follow is what's happening in the Dakotas and Minnesota with finalizing their corn harvest numbers. That's something that that could end up moving some of the USDA supply numbers as well. When we look at basis, this is for Memphis, but most of Tennessee follows a pretty typical pattern. This is one of the important tools that we can use is using storage to take advantage of some of these basis numbers. Obviously, for those areas of the state that have strong poultry, we can get substantially higher basis bids than what's shown on this graph. But again, the predictability of that basis is reasonably strong across the state, so we want to make sure that we're using those in our marketing strategies. This one is what I'm going to kind of use to set up the option strategy I'm going to talk about. It's the 5-year weekly nearby corn futures contract, and you can see it's pretty consistently traded between 460 and 340. So I want people to keep those numbers in their mind when I step through the strategy. We've kind of moved sideways. You can see obviously we're always going to have volatility, but we have this really well-established trading channel on the nearby futures contract over time. So when we think about what works well with this is a strategy, and I actually do like this strategy. I think there's some validity that this would work well for several people in the state. And it involves 2 different processes, buying an out-of-the-money put and selling an out-of-the-money call. And I pulled these numbers as of yesterday. And so again, we can dive into this. If you do have questions, we can talk about this in more detail. But what the goal here is to set a price floor and offset the premium cost by foregoing some of the upside potential. So there's 2 modes of action here. December futures, when I pulled this yesterday, we're at 385. That was the 2020 contract. What you would do is you would buy a 340 put option, December put option for 6 1/4 cents. At the same time, you would sell a 460 call option for 825. So again, you've got money going out to set the floor. You've got money coming in to forego the upside potential. And so your total premium paid would be $312.50. Your total premium collected would be $412. So that $100 could cover transaction costs, or you could pocket the difference on this strategy. So what have you done? And this is one of the reasons why I like it, because there is the potential for continued volatility with the coronavirus, with African swine fever, with the trade issues that we've ended up seeing. What you've done is removed 38 or 88% of that downside price protection on those bushels that are priced. So everything below 340. You have created an unlimited futures loss potential for futures prices above 460, but again, you have the cash crop to offset, and this still allows us to capture those really strong basis movements that we end up seeing in Tennessee. So again, what you really have to weigh on this strategy is, again, what do you think the likelihood of that December contract getting above 460 is between now and contract expiration? So again, this is one where one of the biggest complaints I always get from producers is options are too expensive. Well, if we can end up offsetting some of those costs while establishing a trading range, I think this is a really positive strategy, and it allows us to continue to take advantage of our strong basis numbers. If you don't like those numbers, you can always toggle those strike prices and premiums. So when you pull each individual contract, you will get a list of all the different strike prices and premiums for puts and calls. So you can tailor it for your sweet spots. You can drop, if you're taking the 460, if you lower it down, you'll bring more money in. But again, then you have more risk of it going over that strike price. So again, you can manipulate both the strike price on the put and the strike price on the call, and it'll correspondingly move those premiums. And so again, that doesn't provide any protection on basis movements, but for a lot of us, we think that that's probably a positive. So that's one for corn. I'm going to go through a different strategy for soybeans because we're in a different situation with soybeans. When we look at U.S. soybean production, the one thing that I've been pointing out for most of the winter is consider what we would be looking at in soybeans if we wouldn't have had all those prevented planting issues and got production anywhere close to where we have been in the past couple of years. We're down to 3.56 billion bushels, where previous three were well above 4. So again, this did provide us the benefit of having tighter ending stocks than we have in past years. When we looked at 2020, USDA is forecasting a bounce back in production, but this is one that is a little bit interesting. Their stocks are actually estimated to continue to go down. So again, if we do end up seeing this materialize, we would expect prices to strengthen. And again, a lot of this is going to be driven by what happens with export. So again, there still is a massive amount of uncertainty in the soybean complex. When we look at global supply and demand, this drop in stocks is largely a function of U.S. reduction in production. When we look at kind of our pricing, our price ratios going into the planting season, you can see that we've seen corn kind of become a little bit more competitive with soybeans. And as a result, last year we've seen an increase in corn planted acreage relative to soybean planted acreage. I would expect that we would see an increase on top of that. Maybe not as much as what we were seeing before, but again, I think we will see a bias towards corn when we look at what the planting conditions are. Unfortunately, with soybeans, we didn't see a lot of that same predictable behavior as we did in corn, but we do still have kind of a little bit later time period maybe to price that. The challenge with soybeans is just how much volatility and factors that are outside of what I would call normal supply and demand movements that is impacting prices. And again, you know, not to kind of go through the same things, but African swine fever and coronavirus, we don't know what that's going to do in terms of long-term demand. And then this phase 1 China trade deal could be a real positive, but we'd love to see it kind of materialize before we get too excited about the potential for that. But it is really difficult to imagine a set of circumstances where soybeans do not play a big role in meeting the requirements outlined under the phase 1 trade agreement with US and China. When we look at the November soybean contract, again, we do have a record Brazilian crop that has definitely pressured prices lower. We do have an increase or rebound in acreage anticipated, but we'll have to see if we do have any prevented planting issues. If you look across big chunks of the Corn Belt, soil saturated, and we do have reservoirs, you know, at very high levels. So again, we'll have to see how much of the crop we get planted and what type of season it ends up bringing. When we look at basis, we don't get as predictable of behavior in basis, but we do have some trends that we can pick up. Obviously, we have our harvest, then we have the South American harvest that typically ends up influencing basis negatively. Again, this one is the one that's going to kind of lead up to kind of the strategy that I'm proposing on the option side for soybeans. When we look at kind of that range, obviously we have a much bigger range than what we had in corn. We have all the way down to $8 up to $10.75 in terms of a trading range. We had the big drop back in 2018, and since then we've kind of just moved between $9.50 and $8. So this one is this is more speculative, obviously, than the previous strategy, but this is a way to try to end up increasing the net selling price of the product. So again, this is buying call options. So again, there's no margin requirements on this, but the goal here is to participate in an upward movement in soybean futures for a defined potential loss of premium. So when we buy this, I pulled these numbers yesterday. I used the August contract, but you can use other contracts if that's not the one you want. It was at 9.16. The current 9.60 call option was for 20 cents. So you pay that premium, be $1,000 on a 5,000 bushel contract. And then if the August futures price exceeds 9.80, you gain whatever that August futures price is minus 9.80. Again, there's a lot of distance between 9.16 and 9.80, but I do think that there is the potential, given what we see both on the supply and demand side of things and on the trade front, if we can get out of this coronavirus issue and have some resolution to African swine fever, where there is a legitimate chance that we could end up getting up to this type of level. I'm not as sold on this strategy because it's not really a risk management strategy similar to the one that I shown for corn, but it is a way that you can use options to increase your selling price. This one, it's really challenging with soybeans right now because the current price offerings are not going to get anybody really excited. Anytime you have prices that are bouncing around that 9 to 9.25 range, boy, it's tough to pull the trigger on that and think that you're going to make money on that commodity. I'm not saying there's not producers out there that can't do that, but I don't think people are going to be overly excited with those types of options. So any strategy that we can end up implementing to try to augment the price with minimal risk, you're only risking 20 cents a bushel, I think we should at least consider. I'm not saying this strategy is for everyone, but it's something that I think people should consider. So again, what we're trying to do on this one is just participate in a rally in the futures market. We're not doing anything with basis. You can look at cheaper options when you get closer to the contract expiration. And on this one, you can actually toggle both that strike price and premium, but you can also select different contracts since we're not tied to kind of a hedging strategy that is used to end up protecting against production for this upcoming year. You do risk the premium loss, the 20 cents. So again, this is one where there are benefits and negatives to this strategy. So it is something to consider. Those are the ones that I was going to go through today. And so what I'll do now is I'm going to turn it over to Andrew, and he can go through the livestock and we can discuss questions at the end. So Andrew, I will turn it over to you if you want to share your screen, and I'll get out of your way.
Hey, let me ask you one quick question before we move on.
Sure.
ARC versus PLC.
Depends on the commodity base that you have. Pretty much for most counties, wheat and seed cotton, PLC pretty much all day long, unless you have some incredibly low payment yield on a farm. But those ones are almost no-brainers just because there is a high likelihood of payments. For corn, it's still probably leaning towards PLC. But there are some counties that I did see where ARC County is worthwhile to at least consider. Both for soybeans and corn, there's not great likelihood of payments under either ARC or PLC, but I would probably lean PLC on corn. And then soybeans to me is ARC County all day long, just because I don't think we'll be able to hold below that 840 marketing year average price to trigger a PLC payment. So again, those are on base acres, not on planted acres. So you do have to look at what the commodity base is on each individual farm. For those that do have an oat base, that's another one that was ARC County. Most of the other ones were pretty strong PLC. Anybody that's still left or has canola base on their farm, that was a PLC one as well. So again, getting in and signing up. The one thing that I have mentioned, and again, this affects more kind of the western part of the state, specifically Lauderdale and Dyer County. If you had farms that had 100% prevented planting on them, you may want to consider ARC individual coverage. because if you can plug in a zero revenue into that calculation, you will maximize payments. Now, it's not ARC County, that's ARC individual. It's a different formula. It's pretty complicated, but if you did have farms that had 100% prevented planting claims, that is one to consider. Or if you ended up having farms that had lower than 30% of what your 5-year average yield was in 2019. But most farms, that is not going to be applicable in the state.